There was this weekly expiry in Bank Nifty that I think also added to the volatility. Look, the contours which have been driving the market, they are still intact. I'm just going to exactly repeat what I said yesterday. The contours which are driving the market, number one, big reversal in FII flows. Second, participation which has just about started coming back in mid and small cap stocks. Third, decline in global inflation and the fact that the earnings season this time around has been more than satisfactory. These are the three pillars on which markets are moving higher. Those pillars are still intact. So flows are decent, DI and FI. Liquidity is coming back into mid and small cap stocks, and globally, whether it is whether it is risk on or perhaps a contra trade because of decline in dollar index, I think that trade in a sense is powering global equity markets ahead. So the factors are intact, and if the factors are intact, I guess the trend is also going to remain intact. Within that large trend, which I'm calling it as the summer rally of 2023, you will have a couple of volatile days, few choppy days, but that's par for the course. That's how markets they move. Last week also we had one bad day, one flat day, and 3 good days. This week we've had one bad day, we've had one good day, one flat day. It could be another flat day.
Yep, it absolutely could, because overseas this time around, the kind of cues that we've got, well, most of the major indices on Wall Street ended lower. The Dow down by close to 1% as those debt ceiling talks are still awaited. You've also got the Asian markets, which is looking quite choppy, and the European markets wrapped up the day in the red. You've also got gold hovering around that 2,000 mark per ounce ahead of these talks, and the SGX Nifty as well pointing towards a slightly tempered start. As we did allude to, the FIIs continue to remain net buyers, 16,370 crores so far this month, so 14 straight days on the trot that they have remained buyers. But at the same time, or in the same breath, you've got the demat account additions, which has been quite contrary, and Nikunj at a 9-month low, with the April SIPs flows at a 2-month low. What is this indicative of?
I think it's told, everyone's talking about it, so that's the reason we're discussing it right at the top of the show. What do we have? We have a marginal decline in SIPs, and I don't know why everybody is making it's actually you're trying to make a, mole out of a mountain. And that actually is slightly unfair, because there is a seasonality which would always be at play when it comes to the SIP flows, and there is going to be a year-end effect which would be there. Now, demat accounts, I think this is a function of two things, because 2022 and 2023 have not been great years. A lot of work from home crowd has moved back to, travel has normalized. So a lot of that bulge what you saw in that demat edition was also a function of strong market and work from home crowd. Things have started normalizing. Markets are no longer, or markets at least in last 6 months have not given you excellent returns. So a lot of data what we are analyzing, I think, would be a function of how markets have been rather than a future indicator. But at some point in time, you must also realize that the base effect would kick in. But the red flag here is that if mutual funds, they continue to underperform their respective indices, which large part of the mutual funds have done, I guess the SIP flows will be challenged. If equity market conditions do not improve in next 3 to 6 months, because we only had one good month, I guess there would be a decline in demat accounts. So it is not like Indians are saying goodbye to equity as an asset class, but yes, the moments of sugar rush and this entire linear surge what we saw in demat as well as SIP, I think that could be challenged.
Yeah, but the FII buying continues, so at least that one comfort factor is still there.
Aisha, I think they've just come back.
Yeah.
You look at the numbers. We were looking at numbers yesterday. For 2022, the number was about 1,60,000 crore net sell. The number this year so far is about 30,000 crore. Yeah. I'm just making a point that what if by the end of the year, this year, by 2023, the flow they reverse. So we could be looking at $3 to $4 billion of additional inflows coming back into equity, because they have to normalize their India allocation. The money which went into China by force will come back into India, because China has got their own issues. China may be cheap, but it deserves to be cheap. India is expensive, but it deserves to be expensive. India is the performing market. India is the performing country. India is the market where earnings are strong and the stability of the banking system is solid. All that factors put together, FI has been forced to make a comeback. Look at what the narrative. I'll give you this simple example. The US bond yield yesterday shot up, which means the US markets or US bond markets are telling you that the inflation fear is not over for their economy.
Yeah.
Look at our inflation. We are at 18-month low, and Reserve Bank of India has done a great job in really, slaving the dragon, so to speak. So my limited point is that there are two dynamics which are at play. US struggling with growth and inflation, India where inflation is under control and growth is strong.